Hello, everyone. It is Friday, March 3rd, 2023, and I'm going to talk about yesterday's or actually last night's events around Bitcoin and crypto. Effectively, what we witnessed in a period of time that most people described as around a half an hour was about a 5% drop in Bitcoin, Ethereum, and lots of other cryptocurrencies. And the cause that all the newspapers talked about was they said, well, it had to do with Silvergate Bank. And all I have to say is, at best, there's a very loose correlation to that. And most likely, however, it was manipulation. In fact, it's a masterclass of manipulation that's now happened twice in 2 successive months. Let me describe it. So here are the rumors. The rumors were that some whale dumped 40,000 Bitcoin, which is a little bit less than $1 billion, and that's what triggered it. And that's possible, but it's far, far more likely that what actually happened was a coordinated assault in order to try to make money. And I'm going to describe precisely how that money would have been made, and we'll give you some facts. But let's go first with the facts. Fact number one, it was a drop of about 5% on average. It took place in 14 minutes. And of those 14 minutes, approximately 5 1-minute periods was 95% of the drop. So they were steep, cascading drops over the course of a very compressed period of time. Fact, all but 3 of the 1-minute intervals of the entire event had almost no arbitrages between exchanges. In other words, whether you're talking about US exchanges like Kraken, Coinbase, Bitstamp, or whatever, or US regulated exchanges like them, or you're talking about foreign exchanges where Bitcoin trades against Tether, for the most part, the arbitrages between those exchanges stayed pretty close to perfectly in line. There were about 3 minutes during the most extreme disruptions where there were potential arbs of around $100. And even that is very hard to see, and it was not exactly an incredibly profitable time. Now, what does this mean? Well, it means a couple of things. First of all, it means markets are much more efficient than they used to be. But the fact that this event occurred is still an indication of a need for probably regulation or oversight, and certainly for increased efficiency. But we'll get back to it. Fact, the liquidations as represented by CoinGlass was almost identical to what happened on February 8th. On February 8th, Bitcoin dropped from 23 to just under $22,000. It had liquidations a little over 200 million over a very short period of time. It happened when people were nervous about what Powell was going to say the next day, Fed Chairman Powell, and effectively the market absorbed it, and it was non-volatile after the event, and it wasn't volatile before the event. Last night, Bitcoin dropped from 23.4 to 22.4, basically dropped $1,000, 8 hours of trading after everything came to light about Silvergate Bank. So the market absorbed the Silvergate news very, very well. And then in the early hours of Asian trading, while people in the United States were getting ready to have dinner or drinks and people in Europe were still asleep, the exact same timing that happened on February 8th happened again last night. The move was almost identical. It was the same $200+ million being liquidated. Everything was about the same. So let's talk about what actually happened and what my hypotheses are. There are only really 2 things that could have happened, okay? And I rate that the odds of it being manipulation as about 98%. But there's a chance that it was just stupidity, that someone did actually have Bitcoin to sell and they sold it, and they certainly didn't use CoinRoutes, because had they done so, they would have gotten a far higher price and the market would have absorbed it far, far better. But it's possible that someone sold dumb by either smacking bids on exchanges, doing RFQs to market makers, or in some way not hiding the amount of Bitcoin they were trying to liquidate. It is possible that it was just dumb. And if that is true, then this person cost themselves a lot of money, but we're used to that. And at CoinRoutes, we always see it. We see lots of people doing stupid trades, less than it used to be. But the reality is there are times when the market just gets slammed. But the reality is it's most likely was intentional. Now, why do I say that? So there's one more fact. In the last 24 hours, the total volume reported on perpetual swap exchanges for Bitcoin was 4 times the volume reported on the spot exchanges. And that is even more extreme if one discounts potential wash trading on certain spot exchanges that have less than perfect records at getting rid of that. So, what does that mean? Is the possibility. We in the world of equities used to call this liquidity arbitrages until regulators basically started calling it something they call momentum ignition. Liquidity arb sounds like something that could be legit. Momentum ignition is something that the regulators coined to say you're manipulating the market. What is the essence of liquidity arbitrage or momentum ignition? Well, the essence is you have two products, one more liquid than the other, and the more liquid product tracks the price of the less liquid product. Now, this doesn't matter whether it's treasury bonds or sovereign debt in Europe. There was a strategy that Citigroup called Dr. Evil. You can look this up. It was in the early 2000s. They got fined like 20 million bucks for that. Or trading desks in Japan trading Tokyo index futures versus Tokyo spot. That was very prevalent in the 90s. But in crypto, we've seen this for a while. And basically what you do is this. If you want to manipulate the market, then you gradually build up a large position in spot Bitcoin, so you own it. At the same time, you're selling perpetuals against that, and you sell perpetuals against that, maybe even in a larger size, but at the bare minimum, you sell perpetuals against that. So now you have this position where you're long a lot of spot and you're short perpetuals. Then what do? Then you dump the spot in a dawn raid or an evening raid, whichever, depending on whether you're in Asia or in the United States, and knock the price down $1,000. When you do that, assuming you sold it more or less, sloppily, you probably sold it at an average price of down 500 bucks from where you bought it. Well, that's a big loss, except you didn't have to start buying back your perpetuals until it had dropped $1,000. And if you actually look at the market, somebody, the perpetuals followed the spot down, but stabilized down about $1,000. So if you actually implemented this trade, let's say you had bought $500 million and had that size position and sold $500 million in spot. Well, you do the math. You do on $500 million, you make 2.5% by buying back your perpetuals at the bottom while you sold your spot all the way down. That is an extraordinarily profitable trade. Now, as I said, regulators around the world, whether in individual jurisdictions, would call that a momentum ignition strategy. They would say you're manipulating the market to make that money. And maybe that's so. In fact, one could argue it would be a good thing if there was oversight. To do that oversight, what you would need to do is you would need the exchanges to say, okay, here's the record of all the data. Well, check. Any regulator that wanted to see the data from last night could get that data. And you could actually see all of the trades that were done in both the spot and the derivative markets. Next, if you saw what I just said in the data, then you'd have to go to the exchanges and they have to be willing to give you the beneficial owners, the people who are making those trades. And then you put those together and you have a prosecution. We're a long way from that in crypto. The reality is we need regulators to want to work with the crypto exchanges and with the markets. And I think most would embrace that in order to actually know what happened. The good news is, while this happened in February, it happened in March, it was for 5%. A year ago, 2 years ago, 3 years ago, we were talking 10, 15, 20% moves. In fact, last year, there was one of these examples, it was a 30% move. So if the market is getting more efficient, and if you look at the volatility both before and after the 1,000-point drop, or $1,000 drop, the volatility was extremely muted, meaning the market is getting much more efficient at absorbing these sorts of things. In fact, as it gets more and more efficient, you can imagine a situation where when someone tries to sell that much, they run into a buyer and they get it, and things go badly because the market ends up going back up in their face, and they actually, instead of making 2.5%, start losing money. When that starts happening, this behavior will probably become less prevalent. But in the meantime, it's worth being careful out there, watching what's going on and understanding it. In the global scheme of things, this really didn't matter a lot. Bitcoin, if you look back a week, is literally down 3%. This move just erased a 2% gentle up week and is really still within the same trading range. That's all I want to talk about on this topic. Always be aware of what's going on in the markets and understand there's always some reason why people lose faith. The best way to understand what's going on is to dig deep. So hopefully people found this interesting and educational. Thank you.